For me, what is a perfect index? It is one that represents the actual loaded spot rate in this week with as little to no lag as possible.
Hello and welcome to the Freight Debate, the ultimate destination for supply chain professionals, logistics leaders, and anyone who has ever wondered what keeps the world moving.
I am Rajesh, and with me today, I have Christian Pederson and Patrik Berglund. Welcome, Christian and Patrik.
Thank you very much.
Christian is the global head of ocean contract products at AP Moller-Maersk. With over 2 decades of experience in shipping and logistics, Christian has led Maersk's ocean services across continents and is a pioneer in driving industry transformation through product innovation. Welcome, Christian. Really glad to have you here.
Thank you. My pleasure.
Joining Christian is our own Patrik Berglund, the CEO and co-founder of Xeneta. With over a decade of leading Xeneta, Patrik has helped transform how companies make decisions about ocean and air freight procurement by using data. And he's a big advocate of driving transparency in an industry which has been historically opaque. Welcome, Patrik. Looking forward to this discussion today.
Thank you, Rajesh. I'm excited to discuss this and really honored to have Christian here today.
All right, let's dive in straight into our topic of discussion today. It's about indexing. Though indexing is not an entirely new concept for the industry, there has been a renewed vigor and interest about it across carriers, NBOs, and shippers alike, at least in the last 2 to 3 years. So my first question is for you, Christian. Why is freight industry is rethinking contracts today?
Well, ocean container shipping is and has always been a cyclical industry by nature. As a cyclical industry, it's part of our day jobs to figure out how we deal with the ebbs and flows of a cyclical industry. And we're used to dealing with this vicious cycle of trust and mistrust between carriers and shippers. Now, as Maersk, we have, for decades, or at least as long as I've been in the business, really tried always to figure out how do we make sure we build strong partnerships through the ups and downs of the cycle, and how do we break that vicious cycle of trust and mistrust to really develop a strong partnership through the ups and downs. Now, what is changing in that scenario is that if you compare to the volatility of those cycles in the decade preceding the pandemic to what we have experienced in the last 5 years post-pandemic, the level of volatility has simply increased significantly, basically across all the supply chain parameters. If you look at cost elements that carriers need to deal with across the bunker price, the TC prices, those levels have gone up significantly, but also the level of fluctuation has increased by 2 to 3 times. If you look at the level of unpredictability our shipper partners need to deal with, the demand volatility that is injected into their supply chain has also gone up by a factor 2 to 3 times measured in the monthly volume variation across the key trades. Now, all that volatility, of course, come together in the supply and demand volatility, and as an outcome, increased freight rate volatility. And if you compare the freight rate volatility pre-pandemic to post-pandemic, the level of volatility has gone up by 600% or a factor 6x across all the key markets. Now, that level of volatility combined with our shippers and ourselves struggling to predict when is the next up and down cycle going to hit us and what's that demand volatility going to be, means that we build enormous friction into these partnerships because of that short-term misalignment of interests. So what I believe all of us across the supply chain are really working on is how do we somehow take that friction out of the annual fixed rate contract renegotiations and build stronger partnerships that basically take that market volatility into account with a more objective, market neutral mechanism. And that's what, at least in our case and from another conversations I'm part of, really drive that renewed interest in maybe we should give it another look and really figure out how would we make proper index-linked contracts work in our industry.
So there are few key things to take away, right? There's mention of trust and mistrust between the buyers and sellers of these services. And there was market volatility on both supply and demand side, and the scale of volatility that has changed since pandemic. How does it shape your outlook of the industry, Patrick? Because you are approaching this market from a different point of view than Christian.
I'm just delighted that somebody was able to summarize it so quickly while sort of taking a big step back and looking at what has really happened over the past 5 years and then that previous period. And I think you're spot on, Christian. The key thing from my point of view is to focus on the friction it creates between the buyer and the seller, because it prohibits long-term partnerships and long-term thinking, and it drives a very transactional behavior on both sides. And then the sort of underlying fact that contracts are not forcible, right? That this is, as long as I've been in this industry, right, it's been an accepted practice that if it's in your interest or your benefit, whether you're a BCO or a carrier, you can always step out of these contracts, right? And I think if you look at the RFQ process from a customer point of view, right, it's always been this sort of starting point of Xeneta. How does the market work for the BCO or the shipper? If you look at the process of running an RFQ, it's wildly inefficient to spend, let's say, 6 months from internal data collection to allocation to new vendors, whether it's NVOCCs or carriers, and then a few weeks or a few months into the contract, you go back and renegotiate. Right? So if you just look at that, I would arguably say that they're already in an index-linked contract. It's just ad hoc when it's going to happen, depending on whatever macro event or even micro event, if it's port strikes and stuff like that, that is hitting their supply chains and giving an incentive for one of the parties to opt out of the contract. And it's just flabbergasting to watch, to be honest. I find it hard to find any other commodity of this size that is dealt with so in such an immature way in some way. Yeah. So I like your summary, Christian. I really do, and I think more and more parties or companies, shippers, forwarders, carriers are realizing that there's got to be a better way. There's got to be a better way. But then it's not straightforward. It's not super simple to transition from something that has been done for 10, 20, 30 years, and it's a very relationship-driven industry, and then put something that is, on theory, a phenomenal solution, and then run with it at scale. But I think there is definitely a growing interest in this. We've seen it over the past few years, and over the, I would say, last 6 to 12 months, it's intensified significantly.
We experienced the same, Patrick, in terms at least the interest in coming together and figure out how do we solve this problem. Yes.
The problem I have quite often, and I'm not sure if this is sort of jumping too fast forward here, is that a lot of the motivation behind an RFQ is to get the best rate, right? And we got to ensure that we play our volumes so that we beat competition. And for any of our BCO customers, this is not core business, right? Ocean is not the main product that they operate with. And I've seen, I don't know, it must be more than 10,000 RFQs over the last 13 years, right? There is maybe a handful that I could name drop and say, like, okay, consistently over time, I've seen them have phenomenal rates, but we're talking thousands that are scattered in the market, depending on when they went to market and how they want to compare themselves. If you have large volumes, but you tender at a peak, and then you have a smaller company that tendered when the market had dropped, these are completely different rate levels, but people just assume that, hey, I have the biggest volumes, I'm going to have the best rates. It's far more complex. And I think overall, I would say most companies sort of win and lose almost by a coin flip. I'm exaggerating a bit.
No, but I think that also plays into what I mentioned in the beginning around that business cycle, because I think all of us, of course, do the best job we can to protect the quality and the jobs to be done across the supply chain. Now, you can start anywhere in that business cycle, because I don't think any one party is to blame. It is really a circular thing, right? So, of course, if you're a shipper who experienced the challenges to predict your demands, but also the challenge in predicting, am I going to get the space that I thought I bought from the carriers at the rate that I thought I bought it? Now, it's probably a natural behavior. If you first burned your fingers in that experience, the next time you go, you're going to make sure you get back the money you might have lost. You're going to make sure you buy more space than you may need because you at least want to have some buffer to cover those things. But again, that natural reaction just exaggerates that vicious cycle, right? Because that will just mean that on the other side of the fence, the carrier might see the customers are notoriously unreliable because the contract fulfillment is low. They're not fulfilling their contract. So, of course, at the time when the market turns, that I will have the same pressure in the other direction. And that if we don't somehow break that cycle, we'll keep spinning around that. And that leads to what you mentioned before, friction, but also the workload. Because pre-pandemic, we saw a trend that we were able to start moving our contract coverage longer than 1 year. So the market standard is 12-month fixed rate contracts. But we should move to saying, hey, why do we negotiate every year with the price only go up and down by 200? Maybe we should go 2, 3, 4, 5 years. Now, with the pandemic, the lack of enforceability, of course, meant that was not a very good experience. It was not the right way to solve that friction. Now, right now, what I see is you are moving the complete opposite direction. So you're not going longer than 12 months. In fact, I actually see some that go 6 or even 3 months because you can't predict what you're going to need and you can't predict what the good rate will look like 3 to 6 months in advance. But of course, that just increases the workload by factor 2 or 3, and that inefficiency of resetting relationships and allocations and contracts, it's not very efficient, and it certainly also has an impact on the quality and the focus we otherwise should have on solving the real supply chain problems.
Man, there's so many things I'd like to pick up. I just want to make one more quick comment. I think it's almost it's a bit of a humor to me that a lot of BCOs are approaching this with a 12-month rate agreement to create budget predictability internally for them to give the answers as what's our spend going to be in the next 12 months. And then it rarely happens, right? So the logical sort of sequence for me is like, it's not working today as is. So if we can find a different approach that is in everyone's interest to think long term, then that should be naturally adopted by the industry. And then finally, if we can find a way to remove the focus on whether the rate should be $100 or $500 up or down, and focus on what is the cost of this product being sold 1 day earlier, or what is the risk of having empty shelves and these, I would say, higher impact consequences than the ocean freight rate. Because for the vast majority of companies, from a total landed cost perspective, this cost component is very small in percentage, right?
Yeah, Patrik, I'd like to call back to one of these points that you raised, which is about project predictability. Look, as procurement as a function, they have a responsibility to share this with their finance counterpart or planning counterpart. Now, I, as a procurement manager, may be happy with the fact that I have a market-linked rate agreement, but how do I answer to the other function who is always demanding for a predictable plan?
I think we can start that conversation in a couple of different places. I think the fact that this is a small piece, I think a lot of procurement managers are used to this not being a big discussion at C-level. We just expect supply chain to run and the cost to be predictable. Now, for good and bad, the last 5 years have made supply chain cost and volatility very much a C-level conversation. So at least my impression is that a lot of C-level CFOs, if not even CEOs, they are actually aware of the market prices now. So I think the vocabulary and having the conversation around what is the trade-off between margin focus and not paying above market when we're in the down cycle, and it's really about really protecting our margins, versus the supply chain resilience and access to space when the market is hot and you really don't want to miss target to it. I think there's a changing dialogue at the C-level that would be able to start having a vocabulary around. It's not so much whether you're at the time of negotiation squeeze $100 or $200 out, but how are you placed versus market, and are you paying a fair market price, and are you getting access to the space and the service that you need?
Before I go to Patrik, I have one more thing to ask to Christian here. Like, the budget predictability for shipper is kind of the other side of that is revenue predictability for the carrier. Like, do you have those conversations within Maersk, which is about how do we make revenue predictability when there are index-linked contracts, and how do you address them?
Of course we do. And I think that would maybe be the second point I would add a bit before also is, if you really simplify it, our ocean contracts need to solve two jobs primarily. It needs to get cargo flowing, i.e. there's the physical delivery of the service, and it needs to provide some financial risk prediction, risk hedging for either side, revenue or cost. Now, we have tried to fix those two jobs to be done in one contract. Some industries do that well, but typically if you want to do that really well, that requires enforceability of your contracts.
Yeah.
We've tried that. Actually, quite a lot of customers, a few segments do still see a benefit in that, but by and large, what challenges us in this industry is the level of unpredictability of what we need makes it very hard to get a true meaningful enforceability into the contracts. Now, we spend quite a lot of time on looking at what do other industries do that have gone through exactly the same journey. You can take the oil sector, any kind of energy markets, even the dry bulk and tanker segments of the shipping industry. And it's quite a natural maturation for the industry to go through where you separate those two jobs to be done into the contract for the physical delivery, where it's really about how do we make sure we have a fair market price as close to real time of what the market price is today or this month, this week as possible. And that contract is here to make sure we always have aligned interest in delivering the volume when the market is in the low cycle, because my margins are protected. And as a provider, to give and prioritize the space when the market is in the upcycle. And then separate from that, trying to figure out how can I turn to other instruments. And this is, of course, alien to parts of our industry, but very common to many other industries and for many CFOs who buy electricity or hedge currency risk or raw material input. They're actually used to work with these instruments such as futures and swaps to manage those two jobs to be done separately.
It's perfectly 100% aligned with what I think is a natural evolution and a natural solution to the underlying problems of not forcible contracts, the historical volatility, and then sort of the after the COVID period as well, in terms of what is a natural solution for the BCOs and the carriers that could work for both sides. But I have a question, Christian. When we talk about like these $100, $200 swings, the fact of the matter is that I've seen rates from Shanghai to Santos for $50 and $20,000, and after COVID, these swings have been much more prominent. I'm going to do a controversial question for you. Has carriers learned that they can charge way more than before? And I'm not saying this is wrong, because to me it's pure supply and demand, right? But did the carriers learn through COVID that, hey, we don't need to increase with 100, 150, 200, or even 25, I remember was a thing in the past. Now it's 500 or 3,000, right? You see what I mean? Do you think there is, and do you think the market is now consisting of so few players that it's easier for them to shift the price? I'm not talking about price collusion, let me be very clear, but purely supply and demand driven, right? So it's easier for them to create these bigger swings as well. That most recently we saw into Far East into US West Coast, how massively it jumped and then how quickly it came off.
I'm sure there will be many different points of view on this. I don't think it is a carrier behavior pricing strategy. I think it's the reality. So I think if you think about the volatility we've had, so between the financial crisis and up until the pandemic, we had the Hanjin bankruptcy. We had the strike on the West Coast in the US. We had a number of disruptions, but nothing that led to the level of impact that we see now. So I think for me, it is the level of uncertainty in the market and therefore the direct impact on supply and demand. Because I would like to think we had more influence on it, but I think in a cyclical, asset-intensive industry like ours, it is cutthroat competition. It is textbook perfect competition, and it is priced to the marginal variable cost. That means, as carriers, we need to price to fill the ship when the market is weak. But when you do that and you need to price, make money over the cycle, you of course also are forced to be equally disciplined in getting the rates up So for me, I think it is the level of volatility that is going in. It is the level of costs that are overall going up, but also fluctuating on top that brings to it. So I think how the market price is set, that is not changing. It is more influenced by how the market dynamics are changing. Now, what I think is changing more is probably more, do we believe that contracts actually stick through those ups and downs or not? And that is probably the main behavioral change that I see changing, because in the world where the prices went from 1,500 to 3,000, contract fulfillment has never been great, but it was not like we renegotiated or customers moved to 3 months and so on. Now, when the price go from 50 to 20,000, as you envisioned, then contracts don't really work. And that's what we're then seeing. The contract behavior is changing. And as a result of that, I think it is more that we're adjusting the way contracts are designed and executed to more figure out how do we get mechanisms in there that respond to the market rate changes. So summarizing, I don't think the market price setting on the spot side has changed at all. It has been influenced by market volatility, but the level of market volatility has influenced contract adherence, and that forced rethinking of contract mechanics and design.
We discussed market volatility drives the pricing behavior, and you also brought a very good point of decoupling the execution of the physical contract and the financial risk management. Now, all of this requires solid data to develop operating framework to make this happen. Like the commodity industries, which we used as example, like electricity, metals and minerals, and commodity grains, they have this structure existing for a while, and on top of those data structure, we have contracts and future and options and derivatives are built. Now, this one is for you, Patrik. Like I have often heard that there's no good index to use in ocean freight and with service. So service has a lot more dimensions. How do you react to that statement? And has there something that has changed, or how do you advise to someone who has this opinion that there is no good index to use?
Obviously, I disagree with that. I think there's a lot of good indices, just to be completely honest. I think one of the main challenges is that there is many different price points, right? There is a huge spread in the market at any given time, right? And there is short-term prices and long-term prices. And then, as Christian said, some is doing 3 months, 6 months, 12 months. So I think the sort of origination of the questioning of indices stems from the fact that people look at their own price, then they look at various sets of reference points, and it's hard to figure out where this price, their own price, should sit versus the reference points. And I think that has historically made it very hard for, let's say, a large volume BCO to look at SCFI and not necessarily even ship on the trades. Let's say you have Rotterdam to Santos, and if you go a few years back, the only reference point that was available was SCFI, more or less, right? So that has nothing to do with the long-term contract they are experiencing from the European to South America East Coast destination, right? And I think that has created a need for other indices to emerge, and today there is a set of them, and I think they have various ways of being constructed. But if you look across them, there is quite a high correlation on a few of them on certain data aspects of it. But then I think it's something about completeness. Like if you take a large volume 100,000 TEU BCO or 10,000 TEU BCO, you need to understand how do they buy in the market? Is it the different contract durations that Christian said? And then you need to assess that versus a relevant data set. A relevant data set, from my point of view, would be other companies contracting at the same time with the same contract duration, roughly. That would say something about how competitive they buy in the market. Then if you stack that up against the short-term market or the long-term market, then you can calibrate what their performance should be versus an index over the past, let's say, 3, 4, 5 years. That would give confidence to have a conversation with a BCO like this about how they alternatively could buy in the market. And I think this makes the transition period for this industry from going to perceived fixed 12-month long-term contracts into an index setup based on a short-term market, because I believe ultimately everything will be indexed against a short-term index, and then it will be budget predictability, as Christian said, would be ensured by other mechanisms, right? So back to your question, Rajesh, I think there is some complexity in terms of the combinatorics when you compare it to oil, right? You have an oil index, and then you have some premiums and discounts in terms of quality, if I'm not completely mistaken. Whereas this industry has different container types, different combinatorics in terms of trades, right? Which makes it a bit more complex to create the strong enough indices for everyone to rely on and trade on.
And that brings me to the point, Christian. As someone who will be responsible for taking the risk of market volatility, revenue predictability, and the data that underlying this indices, how comfortable do you feel today to index or sign index-linked contracts or build derivative products based on the indices that are available in the market today?
I feel quite comfortable, and maybe to caveat that, we're not getting started now on index-linked contracts. I think we work with index contracts since the financial crisis, and we've learned a lot during the period. And we've also changed our definition of what is a good index and what's a good index contract design. And I think a little bit what you reflected, Patrik, from our side, I can share the perspective. From the financial crisis to the pandemic, we focused a lot on long-term relationships, 3, 5, we even have examples of 10-year contract relationships, where we trust each other that we will, over the duration that contracts stick to with each other. And therefore, a good enough index is one that just every year roughly follows the cycle and know that long period it will even out. In that period, the primary index product we offered our customers was based on CTS, or continuous trade statistics. Now, what we learned in the pandemic, when you have the very extreme cycles from the $50 to 20,000 up and down, something that adjusts with a 3 to 6 month lag on an average market level, it is simply too reactive to solve the problems. It's reality. So what we're really working with, and on that, for me, what is a perfect index? It is one that represents the actual loaded spot rate in this week with as little to no lag as possible. That's a perfect, because then you can start saying, what is the real market rates of getting on the ship today? And based on that, you can start delivering the separate instruments. Now, with that definition, there's no perfect index out there today. There are a couple of good ones, or good enough ones, I would say, that we are actively working with as the standards in our products. Xeneta being one of them. But then I would also say, as we firmly believe that this would actually benefit all parties in the industry to develop this. So I would also say we are actively leaning in and open to work with index providers to actually figure out how can we work together to take the good enough indexes and ideally create a couple of really, really great standards for the industry that then the industry can rally around.
From the data point of view, I mean, there is this adage in this industry, right? Carriers hate transparency. And all that we have been talking for the last 15, 20 minutes about index linking, managing volatility, this needs a much higher level of transparency between BCOs, NVOs, and carriers alike to understand each other and each other's perspective, right?
So thanks for bringing that. I think that's a good challenge. I would actually say I've heard the exact same objections from both sides of the camp. So the one objection is transparency is back because I do a better job than market. And the second part is we don't want to drive commoditization. So as a carrier, I'm not commoditized. I'm different than the others. And from a shipper perspective, I'm big or I'm special or I'm good. So I don't need to take a market rate. Now, at least our firm view is we believe that transparency will benefit the industry. We don't believe that either side is consistently beating the market by trading and utilizing the intransparency. That's our view. Actually, on the contrary, a lot of the case studies from other industries actually show you can increase value and increase industry efficiency over time if you increase the transparency. And the part around not being commoditized either as a provider or as a customer, I don't think an index of transparency speaks against that, because it actually simplifies what is your value you bring. Because if you have a very clear market index, you can very clearly position yourself against the index. It's the same thing, again, if we stick to the oil analogy on the WTI, the Brent index. There are different grades of oil. There's oil landed in different places around the world, but they all price back to the same index with a plus or minus delta based on the quality of where you deliver it. So I don't believe that transparency speaks against the interest or against the feeling special or delivering quality. So I believe that is good, but I'm certainly aware that on both shipper and carrier side, there are very different opinions.
I think it's like a misconception from the customer side as well, trying to do indexing, getting the cheapest rates in the market. And I think I just want to be very explicit on that as well. I see that as a real challenge where a lot of the BCOs approach it with, let's say, an RFQ mindset. How can we squeeze this down to the very bottom? Whereas that is 100% contradictory to the fact that you want to ensure that you have service and delivery when the market actually moves. So I think there is a huge sort of educational component in all of this to create something that guides all sides to understand the long-term value, right? And this is what I meant about focusing on not necessarily the exact rate level anymore, but what is the value you can create in a long-term partnership if you can follow the market. And then you have to solve the other piece of the puzzle, which is budget predictability that they're trying to get with these long-term RFQs, squeezing it down. So it's a few pieces to me that needs to come together. And then I think the index itself is going to be one of the easier things. It's moving people, education, and sort of this collaborative approach that is going to be a challenge from my point of view in this industry.
That drives a very interesting point for me, Patrik. And I'll again go back to you, Christian, because I'm still looking at the career perspective. Like, I understand if the industry needs education, there are like a lot of issues of different size, scale, and scope of operation. It may be a significantly hard uplift to educate all of them towards this benefit. Whereas on the supply side, our industry is fairly concentrated. And in that aspect, why there has not been a larger uptake of indexing across carriers and NVOs?
I think certainly the two objections before is a real thing, right? So there's concerns about transparency, concerns around the perceived commoditization, and then there's the very practical angle. How do we do it? And I think we work with thousands of great shippers with great procurement organizations who have, like we do, decades of established practices, very clearly RFQ processes, RFQ formats, fixed calendars. They know exactly how to get it done every year. Now, ripping that apart and figuring out, I'm no longer going by the same line by line and how I benchmark a fixed rate and so on, but to figure out how to actually structure an index deal. That's quite a practical challenge. And it's certainly not difficult to make it complicated. It's a little bit more difficult to make it super simple. But I do believe actually there's an opportunity to make it very, very simple. And really, so I think that this is where we're working a lot with our own product design and processes, as well as for our shippers. How do we together make this process as standardized and simple as possible? And I think there are a couple of components to it, right? There's the index quality and the index simplicity. Do you have a very clear index for each of the main trade lanes? Are you very clear on the mechanisms, such as a plus minus delta based on the quality that you expect? Such as how do we add outports on both sides? So if you have a Asia North Europe contract, let's pick Shanghai, Rotterdam as the main port. We use a certain index for that corridor. And then we agree on a table for how we add Japan, Taiwan corridors on top of that index. And what are the guardrails? What's the frequency? What are there some caps and collars on the contract? But I think you can really bring it down to like 3-4 main choices, and actually, instead of making it super complicated, actually make it way simpler to contract than we do today. But that, of course, requires some standardization a little bit. We are certainly driving that from our side with our customers, and I think this will evolve over the next 4 quarters. Now, the other side is then the execution on the accounts payable side and the contracting side. So one thing is you can agree on the product design. The other one is then the contract execution. So for many carriers and shippers, it's still a big thing to file a contract once a year. But if you need to file a rate that change every month, that's just 12 times the hassle of that and 12 times the invoice quality issues and so on. So how do we solve that equation? And again, this is probably where there's more work to be done for the industry. Standard APIs, rate APIs, and standards to figure out how we simplify that job to be done.
That was a lot. And I'll just summarize for anyone who is listening, because we had some structural challenges in the industry, which is around building transparency, avoiding commoditization of the product. That's a tough word to come up. But then there are some practical and more tactical challenges around how do I build a contract? How do I know that I'm building a right contract, and how do we operationalize this? Now, we'll come back and unpack this a bit, but I want to go back to Patrik, because Patrik, you have been working with lots of NVOs as well, because we have been talking about shippers and carrier dynamics a lot since the last 30 minutes. Do NVO bring a different perspective, or it's somewhere in between what we see from a carrier and a shipper dynamic?
I think,
especially in index uptake point of view.
I've seen a lot of different shapes and forms. Let me give you just an example. I've seen actually somebody agree to a daily index on the NVOCC side. So whatever the index say at the day, that's what they're going to issue. It's super simple, right? Usually for smaller shippers, right? So that they can cater to this. And the NVOCCs know that they buy better than the market average if they have a certain amount of volume, right? So very risk-free from that and them to do that. Then on the other side, the more they do not own the assets as Maersk would do, right? Or CMA or Hapag and so forth. So they have they're in theory more exposed to risk if they do a long-term index agreement with a shipper and they don't have back-to-back with the carriers. I would say that's one of the biggest challenges that we see from the NVOCC side, right? But more and more have we seen back-to-back agreements being made by the NVOCCs and the carriers on this. Primarily on the short-term market for now, but also a little bit on the long-term market. But there is an argument here that there is more flexibility from the carrier side to think long-term and what can be agreed with the directly between the carrier and the shipper or the BCO. But I believe that if you create a financial market, then the NVOCCs have much more flexibility as well to create agreements. So it's a little bit of risk, how much risk they're willing to take on in terms of what kind of contracts they are inclined to offer. But the interest is definitely there, and I would almost say that I find quite often the forwarding side to be a bit more opportunistic and look for opportunities than what I see overall amongst the carriers. It's maybe a bit controversial, Christian, but yeah.
Could be. I don't say, from my chair, it's not controversial. I would actually say, because I can echo it in the sense that we have actually seen the most demand, interest, and progress on this side of product development with our forwarder partners. So I think we have getting to standardized index-linked contracts with our forwarder partners has really helped us to take some of the friction and misalignment of interest out of that equation. So, and I think they've actually shown the agility to figure out how they work on their side to either take the risk or pass on the risk. That's of course part of their commercial go-to-market. But between us, it's actually a segment where that's worked really, really well for us so far.
Do you see a certain pattern around who are these NVOs who are more leaning towards this new form of index-linked contract versus the one who possibly shy? Is there a size, specific technical appetite there, or is it common across the industry?
Maybe not goes particularly into details. I would like to say quite across the board, forwarders are very much tuned into what happens in the market. They're very familiar to what happens in every single market every single day. They have as much, if not more, eyes in the ground than a carrier does. So I think the comfort level in working with this kind of rate products, it is greater. So for me, it's actually more, it's not so much whether they work on index linked or fixed rate. It is more around, do we work online shipment level, like a spot product where you click book pay and see what's the daily rate on the vessel today, or versus whether you put that to a formula saying, I want a little bit more systemic way of working, but I still have a market-based contract and I'm comfortable with that. But I need a little bit more clear agreement on how the price is set. So I don't need to sit and approve that on an every single vessel. There we do see some differences between those that are very focused on a few markets that really want to go for that. They had the agility to optimize. If there's a good deal on this vessel, I can really plan my bookings in the vessel where the good deals are, versus those that have a little bit more maybe global footprint, maybe exposure to larger BCOs, that need a little bit more formula to how is the price set and want a little bit more central rate of forward. But I think that's actually more the choice that we see between, more than it's a choice between index or long-term fixed contract, with at least with our forward partners.
That's super interesting. Now, on that topic, building these index link or market link contracts, I want to go back to the point of where do we go from here? Because you brought up the topic of standardization and building the contract. And Patrik, you as a sort of key data provider who is an index that backs some of these contracts, how do you see going from here towards the problems that Christian explained on standardization and building good contracts and building best practices around these contracts?
So if I go first, I think this is one of the core purposes behind our business, right? And we continue to iterate on the data, the product. I think Christian has challenged us with a lot of valuable components and a lot of insights that we need to take into consideration. We probably going to put together some sort of governance board so that we can bring the key stakeholders from the carrier side, NVOCC side, and shipper BCO side to influence or be more deeply involved with Xeneta. We do have our customer advisory boards today, so probably going to expand on that. And then to me, it's going on the journey collaboratively with the industry and explore how this can be solved with index regulated contracts, financial products. And then I believe seriously it's going to be an adoption curve, and I expect it to move slower in the beginning than in the longer run. But to me, it is so logical that this will change in the industry and that the benefits from all sides are very prominent as long as it's done in a proper way. So it's inevitable that it will happen. That's my honest thoughts on this.
And Christian, how do you see this developing, and where do you see this heading from here?
I do see that this will become standard products that are in the industry. I do believe that there will be a couple of index standards developing, and I certainly also do see quite a lot of interest from other parties that are interested in and that have been part of this market transition in other industries, such as exchanges, banks, market makers on the financial side. So I do see that there's actually momentum and interest in building that other side of what we talked about to build this liquid market. So I do believe we're going to see continued development of, and we're going to see a couple of index standards develop. We're going to see parts of the market. Of course, there will still be room for fixed rate contracts, but I think on the fixed rate contracts, it's going to then work more towards enforceability through these financial instruments. So yeah, I do believe we're going to see a couple of exploration years ahead of us, where we're going to see a couple of VHS versus Betamax standards play out, and then I think as an industry we'll come together around figuring out what is really the standards we can rally around.
I just want to challenge with one more thought, right? Last part of our discussion focused on volatility and the scale of volatility driving this transition. What if this volatility goes away? Or do we think it's going to go away?
Do you know what part of me feel like saying, and I think I speak on behalf of most supply chain professionals, I wish it would go away tomorrow, right? So I'm not too worried about wasted product development efforts. If just this volatility would go away, a lot of other problems would be solved. So I think that would be a good scenario. Of course, it is a scenario, but if you ask me for the crystal ball view, I certainly don't think it's going to go away anytime soon. If you look at what's happening in the world around us, people talk about deglobalization, the increasing regional or geopolitical tensions. I heard a new phrase from a European debate earlier this week, reglobalization. There's so much going on around us. So if I place my bet, I do believe that in the next 5 to 10 years, we're going to see a period of continued volatility. If I should make a change in prediction compared to the last 5 years, it's probably going to be that in the last 5 years, we really saw two major cycles. The pandemic that was up and down in a period of 6 quarters, and then the Red Sea that was up and down in a period of 4 or 5 quarters. And in a lot of the trades impacted, it was a quite parallel curve, maybe with a few months delay, but pretty parallel curves. what I see right now, if you think about the scenario of regulatory barriers like bilateral trade agreements and tariff wars, regional conflicts such as India, Pakistan flaring up, Iran, Israel flaring up and go away again. If there's anything, then it could be that the volatility we'll see in the next 5-10 years it's not going to be a couple of very big cycles. It's going to be a lot of microcycles that's going to pop up, flare away, and it might be different curves based on region. So one region is in a flare up while the other one is in a down. And that, of course, to me, just speaks to, again, it will be even more complicated to manage if you don't have these very agile mechanisms. How do we deal with it flare up? Because there's not going to be a lot of time to discuss how do we deal with this situation and so on. So if you ask for prediction, then volatility is here to stay, potentially with a small adjustment that we're going to move from these macro to a series of micro regional cycles of volatility. But if I learned one thing for sure in the last 22 years is no matter what the crystal ball says, I really can't predict what happens tomorrow. So I'd rather prepare for anything.
I think that's a good way to summarize this discussion that we had. Volatility and macro factors are driving the demand-supply patterns of the industry, and this needs a new way of managing your supply chain and de-risking it from everything that is happening in the world. And some of the tactical advice around building something simple, standardize it across the industry can take it a long way as far as adoption is concerned. And this definitely needs to be backed by data, which is verified, certified, and it's something which is trusted by all the parties that are involved. And that leads to my last section of this discussion. I need all of us to put away the indexing hat aside for a second and sort of go back to the relationship aspect of this industry, because this is a very relationship-driven industry. So my first question is to you, Patrik. What do you wish carriers better understand about working with data? Because you live, breathe data.
I think there is no single answer for each carrier, because if you look across the carriers, their data literacy is incredibly different, just to put it that way. And this is not meant as an insult in any way, but the complexity behind data in this industry stems from the root cause of a mess, meaning the origination of humans typing in on all sides, right? Think about the RFQ process and how the data is injected and then operated. Multi-billion-dollar companies operating on very flawed data sets. So if there's anything I would love for this industry to understand, is that if we created a standard, and I know it's been tried and it's difficult, but in theory, the benefits and awards from having clean, standardized data across all the carriers, all the BCOs, all the NVLCCs would create immense operational efficiency gains, right? All the way from agreeing a price and what is actually a simple way of understanding a price to freight audit and payment, right? There is so much lost in this industry that when I look at it, it's hard to believe how it developed into this without somebody screaming stop and correcting it.
Amazing. I hope that comes true sooner than later. So Christian, my question for you is, what do you wish we as non-carriers, like the data providers, shippers, NVOs, appreciate more about the nuances of running assets?
I think, first of all, I would wish that people actually understand that our mission that we wake up every morning to solve is actually to solve supply chain problems for our customers and get cargo shipped from A to B as our customers expect. That is actually what we wake up to do in the morning. Now, the complexity of that at times is, of course, that the volatility we talked about in the beginning, combined with the fact that our products are perishable. If the ship is not full today and will leave, that I can't resell that product tomorrow. That, of course, means that if we are to somehow recover the cost, to continue to invest in those services and solutions for our customers, somehow we need to figure out the mechanisms of how we combine those partnerships with a way to deal with these ebbs and flows of the cycle whether it is through fixed price with enforceability, whether it's through index linkage of contracts, that problem to be solved. I would wish that shippers understand the intent behind that and really would want to work with us. How do we actually solve that problem in a meaningful way together?
Amazing. I see common thread between the wishes of both of you, which is about driving this relationship from one-on-one relationship to building standards that can span this relationship across the industry and build more trust, as you started with, Christian. With that, thank you so much, Christian and Patrik.
Thanks for having me. It was my pleasure.
And for
Thank you,
everyone who is listening to this and find this valuable, please subscribe on your preferred platform, Apple Podcast, Spotify, or wherever you listen. And we'll continue to explore more of these evolving industry dynamics in future episodes. Thank you so much.